Investors and traders, welcome to the channel Market Chart Pattern. Today is 25th of August 2024. I hope everyone is having a great weekend. This video is for educational purposes only and it's not a financial advice. First of all, apologies for lack of videos the past week. It's because of some engagement with the family. It's the kids' holidays in the United Kingdom, so it's a pretty busy time. But I do promise that next week I will be making a lot more videos and we'll be taking a look at regular segments such as the technology stocks, the financial stocks, and also the sectors in the US stock market. So the chart we are looking at is the daily chart for the Dow Jones Industrial Cash Index. This one has our timing model on it. In this video, I will not be going into the details of how this model is constructed. You can look it up in the archives. We have been using this model for quite a number of months now, and it has got an uncanny ability to pick the turns in the market. So most recently, we were watching for a minor timing to come in. That timing was between 20th of August to 21st of August. With timing, we have to give it 1 to 2 trading days either side. So we just saw the market go sideways, and in fact last Thursday, just a day before the Federal Reserve's Chairman Mr. Powell's speech at the Jackson Hole, the market had actually closed lower on all the major indices. So this was a minor timing, and we just saw market just goes sideways, and we have now the major timing coming in, which is between the 29th of August to 3rd of September on the Dow Jones Industrial Cash Index. So make a note of that. That's going to be an important one. And after that, we have the 10th of September as well. Now, if we take a look at the Nikkei, here we go. There is some timing on the Nikkei as well. And what Nikkei is telling us, this is the Japan's stock market index. The key date, it's highlighting 5th of September and then 19th of September. So the 5th of September is in close proximity to what we are taking a look at Dow Jones Industrial as well. So a key important date to make a note on the 5th of September. One more point while we are looking at this one is when the Japanese index fell, and this was one of the largest falls it has seen in one day. The market actually went to really key levels, and one of them was this 61.8% retracement of the 2022 lows, and also the 1.618 extension of the AB swing from projection from the CD swing. So we had a number of confluence of two major ratios coming together, which is always something we really like to take a look at. And what the market has done is this far it has only retraced 50%. So keep this in mind, because when we'll take a look at the US stock indices, we'll see a fair amount of difference, but we'll also be doing something really interesting for the US stock indices. We'll be going back in time, and I'll show you how the market was actually looking back then, and there seems to be quite a lot of similarities, but this time it might be a little bit different. Okay, so we'll have a quick look at the dollar index. So here we go. Dollar, as we have been saying for quite some time, 107 level has been a really important top in the market. The market has not been able to take that out. We were really highlighting back around month of May that this open gap, the market was likely to get there. Also, it was the 1.618 expansion. Market just filled that gap, and it's just not been able to take that out. So what it has done is it actually has exceeded the initial target we were watching for, which was in this gray zone, and then further target was at the bottom of this range. This if you look at it, it's just an entirely really big trading range, and once it fell below the 78.6% retracement and below this trend line in blue, it meant that there's a lot of weakness in this US dollar. So what is likely to happen now is, because we are at really from a structural perspective, a possible support level. So the market might actually find some support from this level, might bounce a little bit for a day or two, but looks like this market now wants to head lower. And here we go. This is the weekly chart for the dollar index, and here we had highlighted this gray area, which is in actually a gap formation. So the market is actually likely to go and fill this gap in. It might actually dip into it, maybe 50%. It's also possible it goes and actually tests these lows of the 17th of July from 2023. So from our perspective, the 99 level is really key. If the market breaks below the 99 level on a closing basis, then it would actually mean that the US dollar could actually move lower rather quickly, and it will actually trigger this big ABCD to the downside, which could in fact see these lows around 89, 88 level being tested. US dollar is likely to go further weaken further. We have the technicals telling us that, and also another thing about the US dollar is, if you look at this period from 2021 right into the September of 2022, that's when the Federal Reserve started hiking its interest rates, so really aggressively. And also what this has actually done and what it has actually served is, because US dollar is the world's reserve currency, with a strong dollar, the US has actually managed to export a lot of its inflation out to the rest of the world, because we have seen other currencies such as the British pound, the euro, actually reaching levels which are really depressed levels on a historic basis. So that's why we have seen, such as in the United Kingdom, the inflation figures being higher than perhaps in the eurozone. But now, with the Federal Reserve reaching its kind of objective of 2% inflation, quite likely achievable now, I think we're going to see the US dollar actually weaken because of the possible cycle starting from September, of where the interest rate cuts will come in. And what it will do is, if you look at some of the inflation data, if you break the reports of CPI out, there are two main components to it. There is actually inflation coming in, for example, from produce, so that those are products, for example, imported from China or elsewhere in the world. So these are kind of inflation coming from consumption of products. And then there's inflation from services. So the data suggests that also because of what else is happening in the rest of the world in terms of demand, etc., and the freight rates way lower than what they were in the during the pandemic time, the inflation coming in from the products being imported is actually pretty tame, and it's actually likely to move lower. And the component coming in from the services, that remains slightly elevated, but over time it's also actually likely to reduce. And one of the reasons is that one of the key things to watch is the unemployment rate and the jobless claims that come out. So that's sort of essential data to watch, in my opinion, because if the unemployment rate is likely to go up, it's actually going to put some pressure on the services as well, because maybe the consumers who are using service-based products, they might actually pull back a little bit, so that inflation could actually tame as well. So what we're going to see is, now with the US dollar getting weaker, the other currencies such as euro, the British pound, they are likely to benefit in terms of appreciation in their currency value, which is actually going to help their inflation go lower on an accelerated basis, because the value of their currencies will appreciate. So anything those countries are importing, which because of dollar being stronger, the currencies values being lower, were costing them more, it will begin to cost them less now. So that way we are going to see rest of the world actually also getting closer towards achieving whatever their central banks have got as a target, which is usually 2% in let's say Great Britain, and also in the eurozone. So that's going to be an interesting thing to watch. So now I'm going to shift over to the interest rate markets, and we'll be actually taking a look at those markets slightly different to what we usually do. So just a recap, this is the daily chart for the shorter end. This is 2-year treasury note. And here what we are looking at is basically this big black ABCD pattern, which actually met our target of 3.9% and actually went a little bit lower, and then it's just gone sideways. We were watching for this 4.1% to 4.2%, but it's finding a lot of resistance on the 4.1%. Now the interesting thing is that if we were to actually add the 10-year treasury here, oops, actually let me get rid of it. I want to add it to a separate pane because that way it's a little bit easier to see. So here we go, in a new pane. Boom. So what we can see is that the currently, as of last Friday's close, the 2-year treasury note is yielding 3.92%, whereas a treasury 10-year, which is longer duration, is yielding 3.81%. So what it means is that we have some yield curve inversion, because typically we would expect the longer end of the curve to have higher yields, and that's normal. And the reason is because when we are investing, if it is of a shorter duration, then our risk is less, such as default risk, such as the reinvestment risk, just because the duration is less. So the investor is likely to get the money back quicker. Reinvestment risks, such as the coupons coming back, they could be invested, so money could be made just on the coupon payments being reinvested, all of those things. So when the duration is stretched out, 10 years for example, or beyond that, investors would want to have higher yield, because one is taking more risk. But here what we see is that the 10-year treasury note is actually yielding 3.8%, which is a little bit less than what the 2-year treasury note is yielding. So in my opinion, what is likely to happen is when the Fed actually starts its rate cut program, the Fed fund rates, which are still above 5%, they will begin to actually move lower, which would actually then begin to impact the shorter end of the curve as well. So we should begin to see a de-inverted or a de-inversion coming in the yield curve. So that's going to be a very interesting thing to watch when that happens. Now, something really interesting. I'm going to go back in time, because there is something really interesting happening, which has kind of familiarity with what is happening right now. So let's go back in time to 2007. So this is the yield curve chart. Let me actually blow it up like this. Here we go. So here the interesting thing is that we had actually the 2-year treasury note topping back in June of 2006, and then about a year later we had a secondary top come in. And from a technical perspective, this looks very similar to the kind of pattern that we have in the US treasury note today, and I'll just go back to that a little bit later in the towards the end of it. And one of the really key things to watch is that we had a low come in around December of 2006, a high in January 2007, then a low March 2007, and then a high back into June of 2007, right at the 78.6% retracement of these highs from June of 2006, and then the 1.272 expansion also nearby. And of course, the 2-year was yielding at this stage a little over 5%, which has also been the case recently. And then the really interesting thing to watch is that what happens when the rates or the yields began to move lower. We got to a point where it was testing these lows from back of March 2007, and then here is perhaps there might have been chatter about the rate cuts coming in or whatever. At that time we began to see, perhaps from the support coming in from this region as well, a slight spike in the yields, but that was just short-lived. And after that the market actually took the lows out. So this is just taking out the triple lows, these lows, the lows from March 2007, the lows from December 2006, and an accelerated move lower in yields for the 2-year. And then the actual rate cut happened in 18th of September. I believe it was around 18th of September 2007. That was the first rate cut. And then what we saw was actually the stock market kind of rallied during this period. And then finally the markets, which is the S&P 500 and Dow Jones, and I think the NASDAQ topped a little bit later, but they topped in the early part of October 2007. So that's really interesting. It's there's a lot of analogy with what the interest rate markets are doing right now on the 2-year Treasury note. The only caveat is that this is also an election year, so this is really interesting. So just wanted to put this out here and show you guys. Now if we just move to the current period and try to make this analogy here, here we go. So what we have seen is basically a high which came in October of 2023 and a secondary high coming in April, and then the market has gone and retested these lows around this region and kind of is finding support here. So I think the key takeaway we can take is from that analogy that if the yields kind of slightly rise, but then if they're able to take these lows out and begin to decelerate really quickly, that's gonna be an indicator that the interest rate markets, they are telling us that okay, perhaps a further or a stronger rate cut is needed. What do I mean by that? At the moment, the market is kind of pricing in about 50 basis point. It's kind of expected from the Fed in the month of September. Now, the Fed also said that actually they are data dependent, and during that period, if the data on the inflation basis or on the jobs basis, unemployment basis is stronger, then perhaps they might do a smaller rate cut, which is 25 basis point, for example. In my opinion, the markets might not like that, and then we could have a fair amount of volatility in the markets. And then if in my opinion, the Fed actually goes and as not 50% but 75 basis point, so not 50 basis point but 75, that could also be perceived that maybe economically things are actually quite bad, and that's why the Federal Reserve has gone and done a larger than what an expected rate cut. So that kind of scenario actually might trigger some sort of fear from an economic perspective, and create a fair amount of volatility. So that's a possibility. So we'll have to wait and see what sort of rate cut we could get. But the markets are sort of in the way pricing in 50 basis point. 25 basis point might be too less, 75 might be too much at this stage. We'll have to wait and see. So the clue that we'll get is actually how this market, when it breaks these lows, what sort of accelerated move we could see to the downside, and the bond markets will be telling us quite a lot about it. Now, what we can also do is while we are at it, take a look at the stock markets going back to 2007. So here we go. Let's take a look at the Dow Jones Industrial, and I'm gonna move over to the July 2007. So here, let me actually move this to candles. It's a little bit easier to see. So here what we can see is we had 17th of July where there was a top right here, and then the market moved lower. It moved lower quite a bit. So that was like the first downdraft. And here we go. That was about 10.7% in the Dow Jones Cash Index. And then a market made actually a full recovery of it and went actually slightly higher. But during this time, we also had a rate cut. So perhaps the expectation of the rate cut and actually getting a rate cut might actually have led the market higher. And then finally, we saw actually a top being put in. And then, of course, we knew that that was the beginning of the great financial crisis. And then if we take a look at this on the S&P 500, Here we go, and I'm gonna actually go back in time. Here we go, and here we go. So what we can see is that the first time, 7th of July, we had a top come in. The market actually dropped about nearly 12%. Perfect ABCD pattern. And we have had an ABCD pattern recently as well. We'll just evaluate this. And then the market recovered and topped 10th of October 2007. So that's an interesting thing. There is some similarity to the kind of price action that we have seen. Of course, different kind of fundamentals. And also it's an election year, so there is some differences there. And then if we take a look at the NASDAQ. So this is the NASDAQ, and here, okay, I have to go back in time. Let me just go back in time. So cash index of NASDAQ 100. And now this index was slightly different. One of the things about this index was that actually it's completed this big ABCD. So that's the entire bull market starting in October of 2002 and completing this in November, or shall I say towards the end of October 2007. So this index actually topped a little bit later on. But we had several of these patterns completing around here. We have this big ABCD 1.272 extension of this leg around here, and then the first move down was about 11%, 11.45%, and then of course the bigger one, the next leg, which came lower after these lows were taken out, was about 25%. So perhaps this was a kind of an early warning, but the big difference which we see between the NASDAQ and S&P 500 and also the Dow Jones is that those indices had actually topped around July, and then they made a full recovery of the highs, went slightly higher. And that was just the tourniquetion of the wave, and it was just a tourniqueted wave, and after that in early October, those indices actually topped. So there we go. And what we can actually take a look at now, I've shown you a analogy from the interest rate side of things, and also let's see from a stock indices perspective of what we are looking at right now. So let's move in time. So this is okay. I'm gonna move to the NQs, and I'm going to take a look at this like this now. So this is the chart which we have seen several times. This is the initial move lower in this cycle, and here it's just gone and went down by about 17%. Completed this big ABCD, and the recovery has been really strong. One of the key things is that actually the market has gone above the 61.8% retracement on the futures, and I was actually thinking that we might see some resistance around here, but the market has been much stronger. So it's just gone above the 61.8% retracement. Let's take a look at this on the weekly chart. So on the weekly chart, what it did was it completed this big ABCD. Now, this is not the entire bull market. This bull market has been one of the greatest bull market in the stock market history, or the recorded history. But it did complete this big ABCD, and after that we saw the 17% decline, and now it's right into this danger zone of 61.8%, 78.6% retracement. So what is a key to note here is that I'm thinking that we will actually be in a sideways ranging market for quite some time, and with our timing coming in towards the end of August, beginning of September, we could see a fair amount of volatile time. And if these lows of 5th of August, they are actually taken out to the downside, we could see sharp moves to the downside, because it would also mean that it will be breaking this trend line from this brown trend line shown here. So it'll be actually breaking this trend of the CD leg, and I believe that we are actually in a bigger degree cycle correction, so we could see the market actually move further lower. So this time it was 17%, maybe 25% from top to the somewhere around here. It could happen, but it all depends. If the trend line is broken, but there's going to be a start of something like the what we saw in the great financial crisis. I'm not sure, I don't think so, but I do not know either. We'll actually follow the technicals. There is some similarity to it. I've shown you the 2-year treasury note, how kind of the patterns which are quite similar to which existed back in 2007 to what they are right now. Some of that similarity also exists in the stock indices, but again, the fundamentals are slightly different now. So we'll be watching the technicals. So I'm expecting fair amount of volatility, at least in the early part of September, just because of the timing and where the market is. So if the market gets is not able to make higher highs from here, it is actually in a resistance zone as we speak. This is what the NASDAQ is, and after the completion of this big ABCD, I would expect some good degree of correction. So this is what we are watching in the NASDAQ. Now let's actually move to the SPX. So we'll take a look at the cash index. So this is the cash index. Here we do have a higher target as well because of this ABCD. Now what the market has done is it's just a fabulous recovery. Look at these 3 weeks. It's just so strong. Now it's really important if the market is able to get above these highs of early July and then complete this ABCD, which could actually see this 61,000, so excuse me, 6,100. So that would be actually completing the kind of cycle we have seen in the NASDAQ, but the markets are in different phases. So the really key thing is it broke below this trend line, then it was able to actually reclaim above that. So we'll have to adjust the trend line a little bit, and then the final big trend line is this one. So again, I'm expecting fair amount of volatility, a lot of choppiness up and down in this trading range. So I'm expecting more of a trading range behavior for now, and there is a chance that by the end of the year we might actually be be able to complete this big ABCD. NASDAQ, a little bit different story, but I think we are going to see a really choppy period, a lot of volatility in the stock indices, and then we'll be watching the interest rate markets really carefully to get clues, what they are telling us. And if we see yields rising higher, then that's going to be an indication that okay, pressure will come in the stock indices as well. On the E-mini, here we go. This is the futures here. Fantastic recovery. It's not far away from the new highs actually, so it's actually might be able to take these out quite soon perhaps. And then we have the big ABCD around 6100 as well, but I would expect fair amount of choppiness in the market. So this 5th of August low is really important. If that is taken out, then we are looking at ABCD to the downside. Now let's take a look at the YM, which is going to be the Dow Jones Industrial Futures. Here, of course, these look very strong as well. It shows a different pattern because the ABCD is much higher. So the chances are, if it's able to get above this 42,000, then I think it's really shooting for this big ABCD. But we could see a fair amount of choppiness, and it might remain in this trading range for quite some time, and then is eventually able to get out of it. And the really interesting one is the Russell 2000, because this is the one which has really been in a sideways ranging market because of higher interest rates, and now when the interest rates are finally will begin to move lower as indicated by the Fed chairman, we are seeing a fair amount of strength coming in. So this also shows there's a rotational aspect in the market where we could see different indices do different things. Some of the indices might show a topping behavior, such as the NASDAQ 100, and the others might show a catching up phase. So really watching this Russell 2000 really carefully. But really the chances are, if it is able to break above this 2300, then of course it has a chance to make a new all-time high and then maybe even higher. Now, something really interesting that we also took a look at, which is the New York Stock Exchange Composite Index. This has about nearly 2000, maybe 1500 to 2000 stocks, including ADRs, and then it's showing really strong strength on the weekly chart. So it's gone above our target of 1.272 expansion, so it looks like it's going for 19,980, which is the 1.618 expansion. Whether it'll be able to do this big ABCD, I do not know, but that ABCD still remains there. But I think that this 20,000 mark might prove a fair amount of resistance in the stock index, because the month of September, it could involve a fair amount of volatility, in my opinion. But of course, we'll have to wait and see. And then let's take a look at the gold market. Here we go. So the gold market is the weekly chart. It did something really interesting. So we had shorter term target of about 2500, and above that the 1.618 comes around 2576. So the market pretty much reached that. So the gold market is actually drifting higher, and we have a really key resistance level, or in other words target, at 2700, and beyond 2700 is psychological 3000. So in my opinion, the gold market is likely to drift higher, but it might not be a sprint higher, or it could be just to 2700, and we might enter into fairly choppy period for gold, and maybe a little bit of a pullback. So here I think I will just expect some sort of a trading range. The gold is pretty volatile at the moment, just because it's hitting our 1.618 extension level actually right here. So that's the 1.618 extension of this A B swing from point C. Longer term, this is the monthly chart. We can see the big ABCD pattern around 2700 roughly. There we go. That might prove to be a fair amount of resistance as well, and what we can perhaps expect is some sort of a pullback of few hundred points at least. So this is what we are looking at the in the gold market. So I think I've covered did it in a different format to what we normally do, but just wanted to point out there is some sort of analogy with the 2007 period in terms of how the rates were moving back then, because there was a paradigm of higher interest rates, and then that paradigm was actually broken, and then when the Fed, it was Bernanke chairman back then, he started to lower the interest rate, but I think he was a little bit slower in doing that. And then, of course, no one knew, but at that time was the start of the great financial crisis. But of course, there have been a lot of learnings from that period. The Federal Reserve has got additional tools such as quantitative easing now, which did not exist back then. And then, of course, the Fed also has a lot of room to actually move the interest rates lower quite a lot before actually using some of those extraordinary tools. So it could be different this time, but there is a fair amount of similarity between that period and how the interest rate markets are behaving in terms of key patterns right now. And then, of course, this could have an implication on the stock indices as well. But again, this time it could be different. So we'll, of course, be watching the technical patterns really carefully and try to decipher what the markets are telling us, where the price is likely to move next. So thank you very much for watching the video. Good luck, good trading, and speak to you guys soon.